Hi, and welcome to the latest edition of the JMI Wealth monthly video series. Now, we're recording this in early August, and you may recall at the time of the last update, we had just witnessed the worst first 6 months of the year for the US share market for 50 years, and we'd seen material weakness in many other share markets as well. Now, that share market volatility has continued. However, for once, the term volatility hasn't just been a gentle way of describing market weakness. In fact, the month of July has seen a strong rebound in the performance of risk assets, and it's been accompanied also by significantly lower interest rates, which if I look at that all in combination, it means that the July portfolio returns, if you have a diversified portfolio of financial assets, that performance will to a large degree reverse the losses seen in June. Look, what's changed? Well, to try and give a simple answer to what's ultimately likely to be a fairly complicated outcome with many moving parts, the odds for what I refer to as the Goldilocks outcome seem to improve. Now, that Goldilocks outcome is a world where economic growth slows just enough to take the edge off inflation, where it slows just enough to reduce the need for the expected level of expected monetary policy normalisation. In other words, cash rates don't need to go up as much as we thought, but the economic growth doesn't slow that much that it materially impacts on corporate earnings. And I totally acknowledge there's quite a few ifs in there. Look, it's a tricky path to navigate, and I thought the Governor of the Reserve Bank of Australia recently sort of summarised the situation quite succinctly when he described the path to get inflation back to that sort of 2 to 3% range while keeping the economy on an even keel. He described that as a path being a narrow one clouded by uncertainty, and I think that's a good, concise summary of what's going on at the moment. Now, the overall context for markets, though, continues to be quite sort of complex. Now, most forecasters are now revising down global growth expectations for 2022 and 2023, and US economic data released over the course of July seems to sort of indicate a slowing in the US economy, and Federal Reserve Chair Jerome Powell, he pointed to the role of data as it's released now, what role that's going to play in formulating future monetary policy actions. And that was when he was answering questions at the press conference after the US Federal Reserve raised the Fed funds rate by 75 basis points in July. Now, that position he took, it was interpreted as being a relatively accommodating position, and together with the generally weaker outlook for the economy, that's contributed to interest rate markets sort of rethinking the degree of monetary policy action that ultimately is going to be needed. So look, even in the face of some further upside in official cash rates, we know they're going to happen in the short term. Even in the face of that, longer term bond rates have actually come down and retreated significantly from recent heights. What's really important to consider though at the moment is that there is enough good news to balance out that expected slower growth. So we had in the last few days the recent ISM report, that's the Institute of Supply Managers, their manufacturing report showed that the manufacturing sector in the US is still expanding. And we've got these very strong labour market conditions. They're evident in many jurisdictions. And what they suggest is that household balance sheets, consumer spending, that'll be relatively resilient even in the face of lower growth outcomes, sort of lower house prices and higher everyday living costs. And that's the Goldilocks scenario, and that won investors over in July. Where to from here though? Like right now we're in the middle of the US second quarter reporting season, and there's a lot of focus on outlook guidelines and forecasts. And despite reasonably widespread concerns going into the reporting season at a very high level, fears that people had of material profit outlook negativity seem to have been mollified. And it's hard not to look at how share markets bounced back in July and wonder whether there's a little bit of FOMO going on out there, fear of missing out amongst investors, and that there's cash on the sidelines waiting for the moment to be put to work. In all that though, here at JMI Wealth, we are continuing to take a bit of a cautious approach with regards to our portfolio positioning, but I think we can be clear on a couple of things and a couple of points. Interest rates are now offering significantly better returns than they have done over the course of 2021. We're comfortable making fixed interest investments at the moment into, for instance, the Clarity Fixed Income Fund, and we're cautiously introducing cash that has been on the sidelines into the various risk markets, into share markets. To round all that up, we aren't out of the woods yet, but there is some sunlight peeking through the forest canopy. Inflation certainly isn't under control yet. We've got further bouts of market weakness. They can't be discounted, but I think we're a little bit more constructive about markets than we have been. If you're looking for investment advice, JMI Wealth can help you out. It costs nothing but time to come in and see us and have a conversation about how we could help you. Look, we'd love to see you. You can look us up at jmiwealth.co.nz. All of our contact details are there. We'd love to hear from you.